Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about stock buybacks, the stock market relief rally this week, and the odds of a second half rebound. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Three large banks, JP Morgan, Bank of America, and Citigroup, are all buying back their stock. Is this a smart move?
Oh, good morning, everyone, and thank you, Allison. And stock buybacks are kind of a hot button issue for a lot of folks, and you hear CNBC talking about this all the time. Politicians, tend to weigh in and say that folks should not be buying back their own stock, that there's a better use of capital. But really, when you look at it, a stock buyback is simply the company assessing that their stock price is lower than it should be, and that the smartest use of that capital is to go in and now buy back that stock, generally to retire it. So when you can think of, say, there's 10 million shares of something outstanding, pick a company here and they buy back, say, a couple thousand shares, then they reduce the overall number of shares outstanding. So when you think of the liability that a company has, especially a public company that has a dividend, for every share of stock out there, they owe that shareholder a dividend, usually on a quarterly basis. So if they retire that share of stock, then therefore that's one less dividend that they have to pay. Or if you separate it out from the dividends, if there's, a million shares, of stock, then each share is worth one millionth, right? Well, if you take 100,000 or a million, whatever the math works out to be, if you retire some of those shares, then your fractional ownership of each share goes higher, meaning it's actually worth a little bit more as far as that fractional ownership of the company. So I like stock buybacks. I think it's a great strategy for companies that have extra cash to be able to do that. Now, in the case of the financial companies, what separates them is there's a Fed stress test that's coming up. So they have to go through, and this was born out of 2007, 2009, the global financial crisis, to where now each of the banks has to pass a series of tests, and they have to have capital on hand to be able to pass the stress test, right? And I won't go into the specifics, but in order to show that their balance sheets are nice and strong, that extra cash has to be sitting there as a reserve, and which also means doing nothing. So therefore, that would delay those. The ability to buy back stock, because they have to keep that cash on hand. So anyhow, so it's going through that process right now as far as the Fed stress test for all the big financials. Overall, that's a good kind of smart thing. That's a little bit nanny state. I got that for the small government folks out there. But looking at what happened in 2007 and 2009, the government having to hop in and bail out the financial system, that wasn't that long ago. So overall, I think it's a good thing on both sides. I like that companies want to buy back their stock. I like that the Federal Reserve wants to give stress tests to financial institutions. So overall, I think it's a win-win.
Next, the stock market has experienced a relief rally finally. Is the bottom in?
Yeah, I'll emphasize the finally there, right? So we started the year first 10 of 11 weeks down. I mean, that can, or the past 10 of the week, 11 weeks are down. That can kind of wear on somebody. I know it's wearing on folks out there as they're watching the balances just continue to drop week after week after week. So we're finally getting a break with that. So let's go ahead and take a look at the NASDAQ here, because that's the most pronounced, right? And it's had the roughest start. So often you can say this is, it depends on what chart you're on, right? When you look at a 5-day chart in the NASDAQ, which is this week, right? Looks really good. It was even a shorter day this week. So, things are on their way, right? If you look at the 1-month chart, that gives you a little better perspective of like, okay, well, it's come in some, and now it's starting to bounce. But when you go out to the 6-month, it kind of paints a picture of that first half, right? NASDAQ's down big and starting to bounce. Now, we've seen these bounces before. Saw one back in February, didn't hold. We saw one in mid-March, didn't hold. Saw another one right here at the end of May, did not hold. So, is this the investable bottom? I would say a couple things have to happen here. And Kramer talked about one of them this morning. And that's all of the companies have to reset their earnings to kind of bake in the new reality of we're probably in the bathtub or the U-shaped recovery, depending on how you talk. In other words, market's probably not going to scream back higher. The V shape that we had out of COVID, we've been selling off for 6 months, so it should probably be a turnaround now. Start buying, in a slow rise instead of a quick rise. So that's one. Is we're not sure that across the board all the companies have reset their expectations, and the analysts, of course, resetting along with that. So that's one. And the second is the retail investor has not capitulated yet, which really means, what does that mean? It means people wholesale just selling everything and going to cash and getting out of the investing strategy whatsoever, right? So when that happens, when people just sit there and just sell, that can mark an investable bottom across the board there. So can I look at you and say the bottom's here? No, I like the action this week, but I can't say for sure that the absolute bottom is in, because we haven't had those two things.
Last, 2022 marks one of the worst starts in stock market history. Historically, how has this market performed after a terrible start like this?
Well, that the jury's out, right? But you don't know. But when people say it's the worst market start in history, no, it's not. The 1932 first, dropped 37%. So I mean, you have, that one takes the cake. But obviously, there's a lot of things going on in 1932 that aren't going on now. But this article's on CNBC if you want to kind of take a look at it. And there's two stories here. The rest of the year for all four of these that were off pretty significantly, the market bounced. So you're thinking, okay, well, that's the good news, right? Then markets are going to bounce here. It's time to start putting money to work. I do think it is time to start putting money to work based on everything I've seen, and the midterm elections coming up, I think, will help the market. However, you look at the next column of the full year, that's what it ends up, meaning. Well, where are they? So you're starting after, the second half is here, but that equates out to, like in 1932, after, at the end of that year, it was only down 15%. Say only, that's a lot, obviously. But all of these bounce, so that's the good news, but they're not going to get back to new highs. So don't think we're going to erase all of the losses of 2022 and be slapping high fives over new highs anytime soon. But when you look at these, it was all a couple years before they got to the to the new highs, right? So just take that as a grain of salt, that when markets sell off as fast as they have this year, they tend to rebound pretty hard, and they tend to make their new highs either later that year or off into the next year before we can get tracking higher. So all is not lost. The world is not ending, despite what media is saying, and just hang in there, everybody.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here Monday.